On the 1st of March, 2021, a single insurance contract was allowed to expire. No headlines, no drama, just one insurer deciding not to renew one policy. 7 days later, a $10 billion financial empire was gone, and it dragged a former British Prime Minister, a Japanese tech giant, and a Swiss banking institution down with it. This is the story of Greensill Capital, a company that lent billions of dollars against invoices for sales that had not happened yet. A quick note before we start. No one has been convicted of a crime over Greensill's collapse. Lex Greensill, David Cameron, and Sanjeev Gupta deny any wrongdoing, and a serious fraud office investigation is still ongoing. Nothing here has been proven in court. A farmer's son from Australia who built a finance empire and got himself a private fleet of jets. SoftBank pouring in $1.5 billion, and Credit Suisse packaging Greensill's loans into $10 billion of funds sold to investors around the world. A former prime minister texting the British chancellor from a holiday, trying to save the company that was paying him. And small German towns who woke up one morning to find their savings had vanished into a London startup most of them had never heard of. When Greensill collapsed, the scandal that made the front pages was the lobbying. A former prime minister caught quietly messaging ministers on behalf of a private company. It was embarrassing. It was a lapse in judgment. But it wasn't the reason $10 billion evaporated. The lobbying was a symptom. Underneath it was a financial machine with a design flaw so basic that, once you see it, you cannot unsee it. And almost everyone who handed Greensill money missed it. Lex Greensill grew up on a sugarcane farm in Australia, where his family was sometimes paid late for their crops. He never forgot it. So in 2011, he founded Greensill Capital in London around a genuinely useful idea: supply chain finance. Here is how it normally works. A big company buys parts from a small supplier, but does not pay for 90 days. The supplier needs cash now. So Greensill pays the supplier early, takes a small cut, and collects the full amount from the big company later. Everyone wins. The supplier gets paid, the buyer keeps its terms, and Greensill earns a fee. It is dull, it is useful, and it is completely legal. Investors loved it because it looked almost risk-free. You were lending against real invoices for goods that had actually been delivered. By 2019, SoftBank's Vision Fund had invested around $1.5 billion. Credit Suisse bundled Greensill's loans into investment funds and sold roughly $10 billion of them to clients as a safe place to park cash. Lex Greensill flew between deals on a fleet of private jets. He was on track to be a billionaire. And then he changed the one thing that made the model safe. The whole point of supply chain finance is that it is backed by real invoices, proof that goods changed hands. Greensill's fatal innovation was to start lending against invoices that did not exist yet. They were called prospective receivables or future receivables. Instead of financing a sale that had already happened, Greensill would lend against sales it predicted might happen in the future to customers who, in some cases, had not even agreed to buy anything. Think about what that means. The safety of the entire model came from the invoice being real. Greensill kept the structure but quietly removed the safety. It was now lending money against a guess. And it concentrated an enormous share of that lending on a single client, a metals tycoon named Sanjeev Gupta, whose sprawling industrial empire, GFG Alliance, reportedly owed Greensill around $5 billion. One lender. One increasingly shaky borrower. Loans backed by sales that might never come. The entire tower was now balanced on a single assumption, and on one more thing nobody was watching: a single insurance policy. Here is where it gets fragile. Because those loans were risky, Greensill needed insurance to make them look safe. If a borrower didn't pay, the insurer would cover it. And that promise is what let Credit Suisse tell its clients the funds were low risk. But a huge chunk of that cover came from a single Australian insurer, a Tokyo Marine subsidiary called Bond and Credit Company. The entire $10 billion edifice rested on insurance from essentially one source. Meanwhile, as the COVID pandemic hit, Greensill wanted access to the British government's emergency lending program. And to get it, the company turned to its highest-profile advisor, David Cameron, the former prime minister, who had joined Greensill after leaving office and held what reports valued in the tens of millions in shares and salary. Cameron personally texted the Chancellor, Rishi Sunak, and lobbied senior officials to let Greensill into the scheme. The government said no. A former prime minister, messaging ministers from a private number, could not save it, because the real problem was about to arrive in the form of a letter from an insurance company. In mid-2020, the Insurer, bond and credit company, told Greensill it would not renew the policies covering billions in loans. Greensill went to court to force a renewal and lost. The cover would lapse on the 1st of March, 2021. And without that insurance, the whole story Credit Suisse had told its investors, that these funds were safe, fell apart instantly. On the 8th of March, 2021, Greensill Capital filed for insolvency. Credit Suisse froze and began winding down its $10 billion supply chain funds, leaving investors facing billions in losses. In Germany, regulators shut down Greensill Bank in Bremen, and dozens of German towns that had deposited public money there discovered it was gone, much of it not covered by deposit insurance. SoftBank quietly wrote off most of its $1.5 billion investment, and Sanjeev Gupta's empire, with tens of thousands of steel jobs across Britain and Europe, was suddenly staring at collapse without its main lender. A single insurance contract had expired, and within a week the entire structure was rubble. Here is the part the lobbying headlines missed. Greensill didn't fail because of a former prime minister's text messages. It failed because it took the one thing that made supply chain finance safe, a real invoice for a real sale, and quietly replaced it with a prediction. Once you are lending against sales that haven't happened, to a borrower who can't really pay, insured by a single company that can walk away with one letter, you don't have a low-risk business anymore. You have a confidence trick wearing a banker's suit. And the most sophisticated money in the world, SoftBank, Credit Suisse, a former prime minister, looked at it and saw safe, because the paperwork still looked like the boring, reliable version. The label said supply chain finance. The machine underneath had been rebuilt into something that only worked as long as nobody asked the one obvious question: what was the actual invoice? It is the same disease that killed First Brands, in a different costume. Money moving faster than anyone could verify what was underneath it. So here is the lesson, and it is uncomfortably simple. When something is described as safe, because it is backed by an asset, ask what the asset actually is. Not what it is called, what it is. Greensill's investors thought they were holding invoices. They were holding guesses. The most dangerous financial product in the world is not the one that looks risky. It is the one that looks boring and safe, right up until someone checks. Hype can hide debt, but only until the insurer asks for proof. Greensill collapsed because one lender bet everything on a borrower who couldn't pay. But in that very same spring of 2021, another financial blowup was unfolding on Wall Street, where one secretive trader, using borrowed money the banks couldn't see, vaporized $20 billion in 2 days and took down a piece of Credit Suisse all over again. That's Archegos, and it's next. The link is on screen now.